and Construction Commission. And substantially, I head up the financial assessment unit through QBCC. That has 3 separate arms to it, similar but different. Roxanne is not getting any sound. Can everyone else hear me? I can only see Cheryl McBride. Cheryl, can you hear me? Yes, okay, cool, thank you. I'm not sure if that was an issue from anyone else. Okay, good, there's people that can hear me, okay. Yes, so Financial Assessment Unit head up the annual reporting submissions. They come in through either the portal or manual, so we deal with the lodgements of those and the assessments of those. We also deal with the financial component of a new licence application and any maximum revenue upgrades or downgrades. And then our third stream that we head up is what we would call the naughty chair. So if for some reason we audit or issue a show cause notice for a licensee that may hold some financial concerns for us. So I will kick off. Hopefully you may be able to see the slide. Can someone just let me know if you can see the PowerPoint presentation there?
Looks fine, Nat.
Okay, thank you, Ange. All right, well, we'll kick off if I can get into that screen. Just an acknowledgement to country, wherever you may be sitting at the moment, to the lands that are held by the Indigenous people, and pay our respects to those elders past, present and emerging. A couple of housekeeping issues. I'm not sure where you are placed. If there is a fire alarm in your particular location, please exit. But mainly for the online session, any housekeeping, if you do have questions, please either put your hand up or put something into the team chat. I will try and address it as we go. If not, happy to have a discussion at the end of the session if you have any questions or any suggestions. Just quickly running through the other areas of our financial compliance branch of Queensland Building and Construction Commission. One area heads up the project trust account area. So at the moment, state government contracts 1 mil to 10 mil and private contracts 10 mil and over. And I think there may be hospitals and aged care as well included in that. Essentially, the head contractor needs to pay money into a project trust account, the general or retention accounts, and pay subcontractors out of that for those particular contracts. Money's owed complaints. This one's not a new process. It's been around for a little while. Essentially, a licensee is required to pay their debts as and when they fall due, unless those debts are either disputed or form part of an adjudication or legal proceedings. It is a fairly successful process. If a builder lodges or a subcontractor lodges a money's owed complaint against a licensee that may not have paid, it doesn't work in all cases. If the debt is disputed, there's nothing that QBCC can do. We're not an adjudicator or a recovery area, but it can assist in licensees paying their debts. So pretty important. It can be lodged online. It's a fairly easy process to follow, but there is documentation surrounding that that's required when you do lodge a money's owed complaint. The exclusion process. This one has also been around for a while. It's been tweaked in the last couple of years, but it essentially stays the same. If a licensee is a director of a licensed entity and it has a financial failure, whether it's liquidation, administration, receivership, or personal bankruptcy, Part 9, Part 10, any of those kind of things, they would be facing exclusion from the industry for a period of 3 years. If they come back into the building industry and they have another financial failure, they would face exclusion for a lifetime. So that one's a fairly serious provision. But we'll kick off with the minimum financial requirements. How are we going in the back end? Can everyone still hear me and see me? I can see Darren, if Darren's able to nod. Darren Morris, excellent. Not putting you under the spotlight there, Darren, but thank you for the nod. Okay, so why do we have the minimum fund? Oh, Cassandra's lost the presentation now. Are we having some background issues, or will I continue? Best in Builders, can you hear me? Yes, okay, good. I'll continue on, thank you. The joys of technology. I can see and hear. Okay, thanks, Suzanne. Okay, why do we have the minimum financial requirements? Similar to every other law that's in place, there's an intent behind the legislation. So the intent behind the minimum financial requirements is to ensure financially sustainable building businesses. We often ask the question why the minimum financial requirements doesn't stop someone from going insolvent or doesn't stop them from going broke. We get a lot of criticism in that area. The minimum financial requirements won't ever prevent an insolvency event. It can't and it won't. And the reason for that is it's a totally legal process for an entity to go into liquidation. It's actually a director's responsibility if the company is insolvent to place themselves into liquidation or administration. So the minimum financial requirements won't prevent that and cannot prevent that because it is a legal requirement for that to occur. The minimum financial requirements are put in place to minimise the damage that results from a financial failure. So by that I mean it's similar. You're holding a QBCC license is quite similar to holding a car license. So when you first start out and you drive a car, there's all these laws in place that that you have to abide by when you drive a car. So you've got to have a seatbelt on, and you can't drive while you talk on your phone, and you've got to go a speed limit. None of those laws that are in place when you drive a car will actually stop you from having a car accident. So I can still have a car accident if I drive 10 kilometres an hour. Probably wouldn't be a very good driver, but I can still have a car accident. Those laws that are set around driving a car, they're all set in place. The intent behind those laws is to minimise the damage when you drive a car. It's to minimise the damage to yourself and any pedestrians and maybe the car itself. So the minimum financial requirements are quite similar to that. They cannot prevent an insolvency in the building industry, but they can try and minimise the damage that would occur through an insolvency event. Particularly through annual reporting now, we are a lot more aware and have a lot more visibility over the building industry. So if we're aware of an entity's financial position and it may show some concern, we can step in there a lot earlier and take regulatory action and either bring that company back into compliance or set them out of the industry for a while until they can come back into compliance. And instead of a licensee going broke for, let's say, $10 million, if we act sooner and we have that knowledge sooner, we may only see a financial failure for $5 million. And yes, there will still be $5 million worth of hurt in the industry, but we've prevented that extra $5 million from occurring. So that's the intent behind the financial requirements. Annual reporting and MFR reports. So similar but very different. Annual reporting is only required once a year. And we have been asked the question, how often do we have to do annual reporting? It is every year, it is annual. That won't change. Your annual reporting information is really that quick financial health check of a licensee. It doesn't need accounting standards applied to it, and it doesn't need to be prepared by an accountant. We would say to a licensee, please do go and see your accountant, not just for annual reporting and not just because of QBCC, but as part of managing your business to ensure that you are running your business responsibly. So for the annual reporting submissions, it does not need an MFR report. You don't need to compile an MFR report for annual reporting purposes. An MFR report is only required in certain circumstances, and they're listed there. There are only quite a few of them. They're quite limited to when you do need to provide an MFR report. It's essentially when you first start out in the industry and you apply for a license, you need an MFR report to make sure that you have gone and seen an accountant. If you decrease or increase, so if you decrease your net tangible assets or increase your maximum revenue, you may need to provide an MFR report. If you're audited by the Commission, you may need to provide an MFR report. yes, Sandra, we will have a copy of these slides available definitely at the end, but only in those circumstances do you need to provide an MFR report. So it's not in every case. And if you apply for a license, you provide an MFR report and your maximum revenue may not change in that time, it's likely that you won't need to provide an MFR report for the rest of your working career. Annual reporting information, it's based on 30 June financials. Most licensees have the financial year end date 30 June. There are a limited few that have a financial year end of 31 December and other main dates, but mainly licensees within the building industry mostly have the financial year end date 30 June. There are the set due dates for annual reporting, 31 December and 31 March. 31 December is for category 1 to 7, 31 March for SC1 and SC2s. The reason for those dates, and we definitely recognise and acknowledge that 31 December is not an ideal date. It doesn't, a lot of the building industry closes down over that time. QBCC's closed, accounting firms are closed. So it's not an ideal time. We also recognise that it's quite busy leading up to 31 December. The date that was picked for 31 December is trying to find that sweet spot, trying to provide enough time for the 30 June accounts to be prepared and enough time for QBCC to be able to rely on them. So they're recent enough, 30 June, within that 6-month period for QBCC to have a look and to be able to rely upon them. There's no point providing QBCC information that's 10 months old or 18 months old. It's too old. Anything could have happened in that time. So that 31 December is just trying to find that middle ground, providing enough time to get your accounts prepared by after 30 June and it being reliable and recent enough for QBCC to have a look at them. The 31 March date was set mainly because SC1 and SC2s being the smaller end of town, they may go and see their accountant to get their tax done. So it was trying to hit those at the same time. Very important to note that the annual reporting information does not change your maximum revenue and it doesn't change your last approved net tangible asset position. Only an MFR report will do that. MFR reports, different to that, must be no older than 4 months old at the time that the accountant signs off on them. They can be provided at any time during the year outside of the annual reporting cycle, but again, only if they are actually required in one of those special circumstances. And at the moment, unfortunately, an MFR report is based on general purpose financial statements. So the reason that general purpose financial statements are required for an MFR report is solely due to the Australian and Accounting Standards Board changing the accounting requirements. And those accounting requirements essentially stated if you're big or you need to report to a regulator, it needs to be based on general purpose. We have made submissions to the Department of Energy and Public Works, who write the law, to see if we can get a resolution to that particular issue. We know it is costly and time consuming for a licensee to provide general purpose financial statements. What I can tell you is that the 3 accounting bodies also made a submission to the Department of Energy and Public Works. So CPA, Chartered Accountants and IPA made a very good submission to the government. The Department of Energy and Public Works sought consultation with the the Australian Accounting Standards Board, and AASB said no. We like the law, we made the law, we're not minded to change the law. So until that gets resolved, we are in that middle ground of having to require general purpose financial statements. We are still hoping that the government will change that. Those discussions started in around about September last year. We were hoping for a resolution by the end of this financial year. It's now the 6th of June. We're still waiting on that to come through. We will definitely advise the accounting industry if and when that does change. So we have your details now. We will go out to market and let you know if and when that does get changed. In the interim, if it is a pain point to either an accountant or a licensee, the best thing that I could suggest is that you raise that up through your accounting body and they can continue to agitate with the government to try and get a resolution in that area. What's the difference between not lodging and not meeting? They are very different. different requirements there. So not lodging, the government takes that quite seriously, and they've given us that message for us to take that quite seriously. If a licensee does not lodge by that due date, it's likely that QBCC will take some regulatory action to ensure that that lodgement has been received. Whether that ends up in a suspension or a cancellation, that is what a licensee may face if they do not lodge the lodgement on time. Different if they don't meet the requirements. So when they lodge and they may be short of assets or they may be short of their current ratio, QBCC will decide and take a number of things into account before we lead out with regulatory action. So we are a risk-based regulator, and we will see what risk is available or at risk to the industry before we start or commence a regulatory action. So these are some of the things that we will look at before we consider whether we take a regulatory action on a licensee if they demonstrate that they may not meet the requirements. And what we'll be looking for is any impact to the industry if we take the action, or any impact to the industry if we don't take the action. So we would be aware whether there are employees of that licensee, whether there are subcontractors, suppliers, people not getting paid, whether there are defective works at stake. We will consider all of those things before we commence a regulatory action. What we'll also look at is whether there's a history of non-compliance. So if it's the first year that you may not have met the requirements, or if you've continued to breach those requirements over a number of years, we'll look at that information. Probably the last point on that slide is one of the more important ones. We'll be looking at whether there is a plan to come back into compliance from that licensee. And what that plan will not be made up of, or what we won't consider, is future income. So we commonly get asked or commonly get submissions made that you might be negative of your net tangible assets, but you've got these current contracts that are coming into place. The reason that we won't look at your future income, or may not consider that as heavily as other factors, is we're talking about the building industry. So what you might think might be a $5 million contract, it may not end up as $5 million. There might be variations, or there might be disputes, so you can't actually bank on that money. What we'll be looking for is some kind of injection or some kind of plan to improve that company's financial position in order for us not to progress that regulatory action. So there are a number of reasons, a number of issues that we will look at before we actually take regulatory action on a licensee. Another pain point that we often see as well is, we get asked the question, why do we need to report all of our income? So that's all income, not just whether it's based in Queensland, and not just whether it's based in the construction and building industry within Queensland. Again, behind every law, there's an intent. So the intent behind this law is, if you run a building entity and you also run, let's say, a hairdressing shop out of that same entity, if that hairdressing part or the hairdressing business of that component has maybe high overheads, lots of employees, maybe your materials have gone through the roof, but you're not getting customers into your hairdressing shop, and that then causes some grief where it's affecting the cash flow, which then starts to affect the building business of that corporate entity, that can have an effect on your creditors within the building industry. So that's the reason that we will look at all income, not just whether it's Queensland based and not just whether it's in the building and construction industry. QBCC, trust structures. It's a common misconception that QBCC doesn't like trusts. It's not that we don't like trusts, it's that we don't license trusts. So with trusts, then a trust is not the legal entity. It can't be sued in its own right. It's the trading entity, but it's not the legal entity. So QBCC will never license a trust. It hasn't, and it probably never will for those reasons. So a trust is usually set up to protect assets. Used to be for tax concessions, not so much anymore. It's usually to protect assets. So usually in the building industry, the trustee is the one that we will license, whether it's an individual or a corporate entity. Usually that corporate entity, the Pty Ltd, will only have paid up capital. Let's say it's $2 or $10. In order to meet the net tangible asset test, that entity would likely need to rely on a deed of covenant and assurance from a director, which means that that director then has to personally guarantee their property, their house, their motor vehicle, or something similar to that, which means it doesn't really protect the assets held. So it kind of flies in the face of setting the trust up to start off with. Just something to be aware of if you do have clients in the building industry. If you're setting a trust up for a cafe or a hairdressing shop, probably no problems. Just be aware of it if they are QBCC licensed or working in the building industry, that there may be some catches involved with setting up a trust. The net tangible asset test through a trust structure, that has changed slightly between the MFR policy, what was a couple of years ago, and the MFR regulation now. You just need to be aware that the trust is assessed under the same framework as the trustee or as a normal licensee. So if there's any disallowed debtors or any borrowing costs within that trust, they need to be deducted. And unfortunately, if that means that the trust then goes into a negative net asset position, that may flow back to the trustee entity, and the licensee may not meet the requirements because of that. So again, it's just something that you might need to be aware of when you're looking at a trust. And that's the next slide is essentially explaining that as well. How does a trust structure affect SC1 and SC2s? Unfortunately, the law as it currently stands means that an SC1 or an SC2 cannot rely on a deed of covenant. They need to bump up to a category 1. That is, again, another submission that we've made to the Department of Energy and Public Works to see if we can get that changed, so that SC1s up to category 7s can rely on a deed. At the moment, we're left with the law that we have, which states that unfortunately SC1 and SC2s can't. Excuse me, the other option for an SC1 or an SC2 that trades through a trust, if they don't want to rely on a deed of covenant and assurance from a director, that trustee could be capitalised in its own right, sufficient enough that it holds enough assets in its own right in order to not rely on a deed of covenant. I can see some questions coming through, so I think I've only got 2 more slides to go, so we'll cover off on that and hopefully we'll get to those questions and answers. Common issues that we see with annual reporting lodgements. One of the biggest ones in previous times was the double up of submissions. The portal is now locked. We will only accept 1 submission. And the reason for that is in previous years, we were getting a number of multiple submissions for the same licensee, whether that was from the licensee or the wife or the bookkeeper or the accountant. And we were getting a number of submissions for the same licensee showing different dates. So we weren't sure which one to rely upon. The portal's been locked now. Once a submission's done, it's then lodged. You can't go back and re-lodge another one. Some other issues that we see with annual reporting lodgements, trying to change the license category through annual reporting. That's what an MFR report's for, totally separate process. So annual reporting does not form part of that. Some improvements that we've got lodged for the annual reporting portal include, we have taken feedback from accountants and licensees, and they are in the pipeline waiting to be changed at the back end. We are trying to get it changed where when you log in to the annual reporting portal or your My QBCC portal, you can see your last maximum revenue amount and you can see your last net tangible asset amount. Great ideas. Also be helpful if you could see your last lodgement, maybe from last year, so you can see what figures you had last year. If you do have any suggestions like that, definitely happy to take them on board and try and get some improvements done to the system. And lucky last slide, if I can change that. Some common issues that we see with MFR reports that are lodged, again, separate to the annual reporting process. We can't accept financial information that's outside of that 4-month bracket. Unfortunately, we don't have any discretion there. General purpose versus special purpose, at the moment, we don't have that discretion either. Provided amended statements, so same reporting date, but showing different figures. Maybe that's because QBCC has raised a concern there. Again, we don't know which one is reliable. Clearly, one of them is unreliable. If including related asset loans in calculations, if they don't have to be included in calculations. If they are included in calculations, the asset component of that needs to be accompanied by documentation, and whether that's the balance sheet or statement of financial position for that related entity. On the flip side of that, a related entity liability loan, they can't be excluded for any reason. All liabilities need to be included. And if you're relying on a deed of covenant and assurance, all of the documentation surrounding that covenantor needs to be provided. Although having said that, if you are relying on a deed and you're providing the covenantor's statement of financial position, and the property of the director's worth $5 million and the bank account shows $5, we don't need to see the bank account for $5. What we'd be looking at is that material asset that they own, and also the mortgage liabilities surrounding that. I can also tell you that we do have a fairly new commissioner, Anissa Levy. She's been on board for just over 12 months. She is quite serious about the effect that that a financial failure will have in the building industry. And whilst we rely quite heavily on the financial information that's provided for a licensee, whether it's either through annual reporting or through an MFR report, we are going to move into the space where if an MFR report is provided and all of a sudden the licensee may fail within a short period of time of that, you may find yourselves being looked at from the accounting perspective as to what you've signed off on those on that particular entity. So just be aware of that as well. I'll head into the chat now and I will see if I can answer some of the questions that have come up, and we'll start at the top. CPA is very silent on providing training on this, what is required in the general purpose accounts. That is something that you would need to take up with your accounting bodies on what is provided, but essentially it's either full disclosure or simplified disclosure for us. Fix the sound, that's good. Hopefully everyone can hear that. Copy of the slides will be available. What if your NTA increases by 20 or 30%, but your income's still the same? You don't need to provide anything if your income increases. That's awesome. It's if your if your net tangible assets increase. It's if your net tangible assets decrease by 20 or 30%. So that's the trigger to provide an MFR report. If you, one from Chantel, if you do an MFR report based on 30 June figures, are you still required to do the annual reporting based on the 30 June figures again? No, not the same. We can use the same figures. They're just lodged in different purposes. So yeah, your 30 June figures for annual reporting can be lodged via the My QBCC portal, whereas an MFR report would be lodged via the MFR queries email address. So the same figures can be used. It's just that they're lodged in different formats. James says, I have been asking my professional body for an example. That is the place to be asking them. How about government subsidy? Does that still need to be included for your actual revenue? Unfortunately, yes. So it's all streams of income, regardless of where that has been earned from. Work in progress is an intangible asset. No, it's not. It's definitely a tangible asset. It's included in calculations of current asset and net tangible assets, definitely. Lucky last question so far. For Porter Davis leftover projects, how can we find out how to take over from QBCC point of view? Great question. If you wanted to, Best in Builders, if you wanted to email me, I can provide some details of that for you through our insurance claims process. I can definitely find that out and get back to you on that one. Is there any other questions that anyone has, any pain points? Michael, thank you. If your income drops by 10%, is an MFR report required? No. Similar to if your net tangible assets increase, don't need anything. If your income drops by 10%, no. It's only if your income goes over the 10% mark. If it drops, if your income drops and you're still within your maximum revenue threshold, that's totally fine. So only if the income increases. James says, my accounting body has not been responding to my requests. The best thing I can suggest there is continue to agitate with your accounting bodies for that. Do you foresee any changes? Francis, Dream, financing? Yes, I can only hope that we will get changes to the general purpose financial reporting requirements before 30 June. That is our goal. We have put up the submission to government that we would like and I should probably clarify that a little bit better as well. General purpose financial information is only required for, at the moment, A, an MFR report for all categories, and B, category 4 to 7 licensees for annual reporting information. At this stage, special purpose can be provided or internal management accounts for categories 1 to 3, but at this stage, categories 1 to 3 providing an MFR report are required to provide general purpose. That's where we're trying to get that relief through categories 1 to 3 if they are to lodge an MFR report for whatever reason. We are hoping to get that solution, as I said, by the end of this financial year. And again, the best I can suggest, and I agree, Francis, it would be wonderful. The best I can suggest is if it is a pain point, please continue to agitate that through your accounting bodies. I know they have been very vocal with the Department of Energy and Public Works to try and get it changed, as are we. And hopefully there will be a resolution at some stage very soon. What I can tell you is, as soon as we know, we will sing it from the rooftop and we will tell everyone that has come to one of these sessions that it has been changed and what the solution looks like. Michael, you're very welcome for answering your questions. The purpose of general purpose is to get a greater look forward, yes, into being into future considerations for anyone else reading this. Yes, I don't disagree with that. It's just that the impact to the industry for those smaller categories may be a little bit more significant, probably more so for category 1 and 2s if they are needing to provide an MFR report for whatever reason and they have to provide general purpose. It can be a bit of an impost to them. Can you see any relief for trusts in increasing their levels in the future? Maria, can you just clarify whether you're talking about a trust structure for licensing or if you're talking about project trust accounts? I'll come back to Maria on that one. When market valuing assets, what are QBCC's expectations in relation to motor vehicles? So it depends on whether, Gavin, you're talking about annual reporting purposes or providing an MFR report. For annual reporting purposes, totally accept that there are great tax concessions. If you go and buy a motor vehicle, you can essentially depreciate it down to 0. That's awesome. That can still stay in your books as 0 for annual reporting. No problems with that. We recognise that that is availability from the tax office. We would only ever lead out with regulatory action if we saw that your balance sheet was missing something, if we had concerns about your financial position. If you need to revalue it through an MFR report, so mainly a motor vehicle, sometimes property, if you need to revalue that and put it back into the balance sheet at its market value, what we would be looking for is the correct accounting standard to be applied, that revaluation reserve in the balance sheet and profit and loss statement, and something like whatever value you've relied upon, or sorry, whatever evidence you've relied upon to come up with that value, and whether that's carsales.com or something like that for motor vehicles, or it might be a drive-side valuation for properties. Hopefully that's answered that one. Maria, trust structures for licensees, and your question was, can you see any relief for trusts in increasing their levels in the future? I'm not sure if you are referring to SC1 and SC2s. That is something that we are requesting relief on, where a SC1 and SC2 can provide a deed of covenant and assurance. If they're in those categories, they don't need to move up. Until that law gets changed, unfortunately, there is no relief. Again, if that's something that is a pain point, also please raise that with your accounting bodies and hopefully they can agitate that as well. Suzanne, a deed of covenant, we obtain information to make sure the covenant has enough to cover, but did realise the source documents for the deed are required. No, the source documents aren't required for a deed when lodging an annual report. That's only for a deed of covenant and assurance, that's an MFR requirement. For an annual report, if let's say it's a trust structure and that trust relies on a deed from a director to meet the net tangible asset requirements, all you would do is lodge the information for the trust trading entity for annual reporting. When you go to log either through the portal or on the manual form, it has a section where it says, what is your business structure? You would say, I'm the trustee for a trust. We would then recognise that there is a deed of covenant and assurance in the background for that. Oh, good question, Peter. Is the licensee required to write to QBCC to release the covenant? If a covenant or a deed of covenant and assurance is required to be released or revoked, the only way you can do that is unfortunately providing a new MFR report for the license to show that the licensee no longer needs to rely on that deed amount as an asset. And then if that is accepted and the licensee shows that they've got their sufficient NTA in their own right, you can request the revocation of that deed from that covenantor. Hopefully that's answered that one. Any other questions? These have been great questions. I'm going to use some of these in the future. Any other questions while you've got me? Also happy to take any offline. In general purpose, is the income tax expense journal required? No, we don't require journals for anything unless we specifically request them. Chantel, for the withdrawal of deeds and the license has been cancelled, that is a great question as well. Similar process, but different. So an MFR report's only required for a licensee. We don't require an MFR report if the license has been cancelled. If you've got a license that has been cancelled and you are requesting the revocation of that deed, that's a solvency test. So it would be financial statements for that licensee. And if we can see that that licensee is solvent, then that deed may be released or revoked. Michael, assuming it's mid-year, I'm not sure what that question related to. I apologise, I can't see any other question. Michael, I'm not sure, assuming mid-year, I'm not sure what that is referring to. I apologise. If you, oh, sorry, there you go. I think I'm okay. Julia, are you looking to update the portal? Yes. Yes, we are. Similar to trying to get the law changed. Large waiting times at the moment and don't know where MFRs are at. That's not a portal question. So MFRs are through the MFR queries inbox. The portal is used for the annual reporting process. There shouldn't be large waiting times to log your annual reporting information through the portal. I love the idea of having a status page for MFRs. That's a great idea. I will take that on board. So for MFRs, if you're logging an MFR report for an upgrade of turnover, that's mainly that's mainly the reason, the more common reason that you would lodge an MFR report. There is a significant waiting time, usually about 8 weeks, and the reason for that is we have a number of them to get through. At any one time, we've got around about 200 MFR reports waiting to be assessed, and it is a manual process. It's not an automated process by any means. That client can continue to work whilst the MFR report is being assessed. Is there an area in the portal where accountants can confirm the revenue of a client? That's one that we have added to the fix for the portal. We would like for accountants to be able to log in and see all of your clients instead of the other way around. Instead of the client having to log in or you log in for the client, you can see all of your clients in one spot. And we would also like to be able to show what that last maximum revenue is for that client. That is something that we're working on at the back end. I don't know the time frame of that. But it is definitely an improvement that we would like to see. Michael, is QBCC still receiving a lot of special purpose incorrectly? Unfortunately, yes, for MFR reports. Unfortunately, yes, we are. Or how do you tell if it's general purpose or special purpose by glance? It says in the report whether it's special or general. If it's when a report comes in, you do actually need to specify whether it is general purpose or special purpose. We can also usually tell by the level of disclosure within that report whether it's general purpose or special purpose. So again, the categories, so if you are providing an MFR report, we do need general purpose at the moment. For annual reporting purposes, if you're a category 1 to 3, you can provide internal management accounts or general purpose, we would accept. If you're a category 4 to 7, for the next round of annual reporting, which is due 31 December 2023, it would be general purpose information. Any other questions, comments, feedback? I do love that one about having a status for MFR reports. I do love that suggestion. I'll add that to the list and see if we can get that one done. But otherwise, if there is any questions that you think of, thank you. Sounds like QBCC and accountants are on the yes, I believe. And Michael, I share your view about other parties perhaps not being on the same table, on the same page. Hopefully we will get that resolution shortly, and we will definitely advise if and when we do. If there are questions, I think you may have Angela's details and mine. If not, please reach out to Angela and she will be able to provide mine. Our best in builders definitely get back to you on that point that you raised. Thank you. Maria, for contractors who are not computer savvy and don't access the internet but have completed the authority for accountants to act on their behalf, can their information be added to the accountants portal? That's another great one I'll take up. It would be nice to have the authorization process a little bit more streamlined. If you don't provide a compilation report, you don't provide an audit report, what report do you provide with general purpose? That is up to the accountant of whoever's signing off on that information. Again, we would take either an audit an audit review. A compilation review cannot be done for general purpose, so it would need to either be an audit review or an audit engagement or a review engagement for a general purpose. If there are any questions that you can think of afterwards, please do not hesitate to reach out. The reason for us coming out back into the industry to find out what the pain points are is to try and make your lives a little bit easier. And if there are points that we can take on and try and improve our processes, we will definitely do so. There are things that are outside of our control, like the change from general purpose to special purpose. If it's something that we can try and get changed for the better of the industry, we will definitely try and do that. Thank you very much for your time. This has been recorded, so if you need a copy of the recording or if you need a copy of the slides, please don't hesitate to do so. Thank you, everyone. Happy Tuesday, and hopefully we will be in touch at some stage soon. Thanks, everyone. I will